please.
Okay, thanks for the invitation. I will talk about the role for regional integration agreements in the architecture of international finance. I will elaborate on basically two issues. First, the functioning of the international financial architecture and Latin America, and that under that system previous to the crisis. And then I will talk about what are the problems after the crisis and the possible contribution of the regional agreements. So the first point has to do with the volatility and crisis matter in LA, and the pre-crisis international financial architecture was not effective at reducing volatility. I will point to the certain issues that I think are important. I am not that optimistic about volatility in Latin America under the current circumstances. And so I think we have to take into account that excess volatility in Latin America is a fact, and I put some highlighted some stylized facts. The first is that aggregate volatility is substantially higher than in developed countries, and this is so now. Consumption is usually more volatile than income, and investment volatility is high as compared to international standards. That crises have been frequent. Several countries experienced at least one important crisis in the second globalization period, but the frequency of these crisis occurrences differs. This is very important because we didn't have a crisis together with the subprime crisis and Lehman Brothers and all that. But the point is that there was a reason, and I will emphasize this, and the reason was self-insurance. But I don't think this self-insurance strategy is sustainable in the long run. That's why I'm emphasizing some issues that I deem are very important. The simultaneous occurrence of financial and real shocks, for example, interest rate and terms of trade shocks, compounds the size of growth collapses. Just to show you the kind of phenomena we are talking about here, I'm showing a graph of acceleration and collapses in Latin America since the 50s, and as you can see, the importance of collapses, they are the green bars, are very important during the debt crisis, the Russian and Argentine crisis, and there is no acceleration during that period. So the point is that external shocks and basically financial shocks killed growth and produce collapses. These are sudden stop phenomena or occurrences of sudden stop and large trade shocks in LAC 7. And as you can see, they are very frequent in many countries, the largest countries in the region. And another point which is very important, and this occurred during 2008, is which is very the region is vulnerable to the simultaneous occurrence of trade collapses and sudden stops. And this, for example, I put the example. I am showing the example of Argentina at the beginning of the current decade. So these are facts corresponding to Latin America, pre-crisis Latin America, and what were the weaknesses of the international financial architecture from the point of view of Latin America. Well, first, that financial stress associated with sudden changes in risk aversion and domestic deleveraging causes strong output losses and has long-lasting deleterious effects on the aggregate investment rate. Currency and term mismatches play a role in nurturing financial disequilibria. The government acts as an insurer of last resort, and the fiscal imbalances provoked by the bailout of the banking system tends to erode public debt sustainability and affects political legitimacy. I think this is a lesson for Europe now, no, and the States, because the public debt is going up because of the financial crisis, and perhaps there will be political problems in the future. The authorities are unable to implement appropriate anti-cyclical policies in a context in which capital flows behave pro-cyclically. I would like to emphasize that we have been doing well during the crisis, but the fact is that our GDP fell by 3 or 4% in Latin America in the last year. The effect of the crisis on the region was not nil at all. So anti-cyclical policies were carried out, but the fact is that they weren't too effective. The resources that international financial institutions provided to counterbalance capital outflows and ease the credit crunch in the past did not suffice to significantly smooth aggregate fluctuation. This is a lesson for Eastern Europe, perhaps. No? And more often than not, the conditionality attached to the funds did not help either. So these were the weaknesses and the shocks that we have shown during the 90s and 80s in Latin America. The problem is that in the current decade, Latin America learned these lessons and prepared to the future. And the basic strategy was self-insurance. And this was the case not only in Latin America, but also in other countries in Asia, like Korea, etc. And this means that the number of emerging countries that experienced episodes of financial stress and sudden stops in the 1980s and 1990s adopted a self-insurance strategy in the period prior to the international crisis. And my point after the crisis is that the widespread use of self-insurance strategies has fed global imbalances, just like China's trade surplus. So I put some examples here because the graph tell an interesting story. No? For example, if you look at Argentina, Argentina has a deficit, current account deficit throughout the 90s, and then huge trade and current account surpluses and accumulation of reserves. This bar is signaling the time of the crisis. And if you look at other countries, for example, Brazil is the same, current account deficit, then current account surpluses and reserve accumulation. After the turmoil, then you have Chile, the same trajectory, or you see here current account surplus and accumulation of reserves. For example, if you look at Chile, you say, okay, but they didn't accumulate reserves. Yes, but they did accumulate a huge sovereign fund. So the point is that all these countries, the same one. I put just a country out of the region, Korea, the same pattern. And Mexico. Mexico is interesting because Mexico did not have the current account surpluses, but reduced current account deficits. And again, reserve, international reserve accumulation. This is Russia. Russia looks like Argentina or Chile. Huge accumulation of reserves and huge current account surpluses. So this I think that the counterpart of the bad functioning of the international financial architecture during the 90s, the counterpart of this was the self-insurance strategy of the 2000s. But the point is that this led to a crisis and the so-called global imbalances. So the Latin American countries, and especially the countries in the south, the countries that are that are specialized in natural resource export, are running current account surpluses, huge current account surpluses, and this will not be sustainable if global imbalances are going to be corrected in the near future. Why? First, self-insurance might hinder global recovery. The continuous generation of trade surpluses contributes to the preservation of the existing global imbalances. For example, the higher the trade surpluses, the lower the increase in imports in emerging countries. And I would like to call attention to the fact that everybody is expecting that emerging countries are going to grow faster. But if they run trade accounts, surpluses, we are going to have a problem with international trade. It seems obvious. Second, self-insurance is suboptimal response from the national economy point of view because valuable savings are diverted from productive investment. Less investment, less imports again, and this is very important for developed countries because they sell investment goods to the emerging countries. Excess volatility and crisis create incentives for self-insurance and mechanisms to smooth the cycle and reduce vulnerability should be placed at center stage. This means that this creates a linkage between the financial side of the economy, the international financial architecture, and the evolution of trade, because the higher the uncertainty, the higher the incentives for self-insurance. So the role of the international financial architecture is to prevent the occurrence of global coordination failures associated with liquidity provision, pro-cyclical capital flows, and flow regulations. The reform should be conceived as an institution building, and I underscore this, an institution building exercise to be undertaken at the national, regional, and multilateral levels. And regional agreements, from my point of view, can be instrumental at facilitating the reform of the international financial architecture. In what sense? The role of regional agreements can be the following. First, regional agreement can play a significant role in sustaining and promoting international trade in a world in which trade is not dynamic and beggar thy neighbor policies are a continuous threat. Secondly, regional agreements can provide the framework for coordination and institution building, in particular with regard to, first, the design of mechanisms to manage international liquidity, reducing the costs of and incentives for self-insurance. Secondly, the cooperation concerning the design and implementation of standards and codes that are being produced by the Financial Stability Board, and the reduction of macro volatility via the coordination of macroeconomic policies. So the strategic lines to work on in the future should be this. And I would like to give you some examples of how to work on these issues. In part, I take some lessons from the building of the international financial architecture previous to the Russian-Korean crisis. And I say that this is an exercise in institution building. Why? Because on the one hand, you have the international financial architecture, the G20 and other institutions. Now it's very important, the Financial Stability Board. Then you have the domestic financial architecture, the macroeconomic regime. We were talking about the Dutch TCs, the problem of exchange rate management, etc. And, for example, capital account regime, and the financial structure that has to do with regulatory framework, etc. So the point is that you have the international financial architecture, the domestic financial architecture, but there is nothing in between. So the regional agreements could perhaps be the nexus between the two levels. So building the rules of the game after the crisis and will have to do with many questions I'm going to show you to end my presentation. I will focus on the regional dimension, the contribution. First, institution building is difficult in Latin American economies. This is a fact. and recommendations about standards and codes produced by the Financial Stability Board or policies pushed by international financial institutions will not be enough, because this must be implemented. So the regional level can act as an intermediate step to articulate national and multilateral efforts. For example, we have to take into account, and this is not, this is very important, 3 Latin American countries are members of the G20, 2 of them also belong to Mercosur. Regional arrangement can supply key regional public goods. Lack of success in providing these public goods will result in suboptimal, probably unstable unilateral solutions. I have emphasized the role of self-insurance, but also had to do with better than neighbor policies, the regional integration, etc. A blueprint and appropriate context-dependent strategies for institution building and enforcement are needed, and regional arrangement can contribute to internalizing the Financial Stability Board and G20 recommendations, building, and I think this is strongly important, and this is a lesson from the 90s, building a sense of policy ownership, because otherwise Latin America, and especially some countries in Latin America now, are kind of anti-globalization. They are fighting globalization, and so the sense of policy ownership can be built at the regional level. Building the rules of the game after the crisis has to do also with regional agreements that can provide the framework for institution building concerning 3 pillars, which are critical for the international architecture, which had to do with liquidity assistance, monitoring and surveillance, and exchange rate coordination. And this can be done in a better way at the regional level, at least discussed and coordinated. The emphasis, from my point of view, given the constraints that the situation posed now, should be on, first, the design of mechanisms to manage international liquidity, reducing the cost of and incentives for self-insurance. My examples that this can be done has to do with the Chaymaya's initiative, the FLAR, the Fondo Latinoamericano de Reservas, the reduction of macro volatility via the coordination of macroeconomic policies. We did not advance too much concerning this. Regional partners should cooperate concerning the implementations of instruments that encourage more stable private flows. For example, counter-cyclical guarantees. We have been discussing this kind of instruments. Explicit introduction of counter-cyclical criteria in the design of prudential, regulatory, and supervisory frameworks. For example, this has to do with this phenomena. For example, in Brazil, a huge appreciation of the currency in a very short period, and then they have to, in a way, put some kind of barriers to capital movements. Maybe we can build into the regulation more market-friendly devices. Market mechanisms that can better distribute the risk throughout the business cycle in the member countries. For example, GDP index and local currency bonds. There has been a kind of de-dollarization in Latin America, and this is a good news. An evolutionary approach. I think that we shouldn't design on paper a blueprint and try to apply this from one day to the other. Perhaps we need an evolutionary approach to institution building. For example, swap arrangement. Many countries are trying to implement this arrangement in Asia, in Latin America, and to develop bonds markets at the regional level. The China initiative has some experience on this. And I'm finishing with this. regional agreements can play a significant role in sustaining and promoting international trade in a world in which trade is not dynamic, as I have told, and unilateral initiatives such as an aggressive exchange rate policies can harm intra-regional trade in existing regional agreements. I think they can play an important role concerning this. Political legitimacy matters for institution building. This means that in addition to policy ownership, we need to push development, because this is Latin America and we need to develop. So the goal of mobilizing resources for development must be part and parcel of the strategies to strengthen the banking sector and capital markets. For example, strengthening regional development banks. This has been, there are some initiatives by the G20, and also at the regional level we have the CAF here and represented, and institutional mechanisms should be designed at the regional level to mobilize the resources of countries that are generating structural surpluses. This is very important because we have to channel these resources to development, and from this point of view it is very important to push for initiatives to increase regional financial integrations. We are still in swaddle clauses concerning this. Thank you.
Thank you, Jose. And now, Pablo Sanguinetti.
Okay, thank you very much, Andres. It's a pleasure to be here. Thanks to the Wilson Center, to the Mercosur Network. Okay, so I would take in a very direct way the question posed by the panel, okay, which is a role for regional integration agreements in the architecture of international finance. And it's nice that the panels that we have in the morning already describe a lot about the regional trade integration initiatives in Latin America. So the whole story about these things is already discussed. So which for me is an input to the discussion. So what I plan to do is these 4 things, okay, which is more or less what I will try to, my organization, my presentation. I will take a lot the structure of the presentation of Jose Maria to do my own comments. So first of all, I would do a little bit, very briefly, the pre-2008-2009 management of macro crisis in Latin America under the old international financial infrastructure. I have there a little sentence that sort of summarizes my opinion about that, which is better to die alone than with bad company, in the sense that you will see. Then we have to think about the new financial, it's difficult to say, architecture, that's the name, okay. The new international financial architecture. It is good to think about the lesson from the last crisis, which already Jose Maria already talked about. So for me, the lesson from there is saving pace. Okay. Now, as a third point, I'm going to go directly to the idea of the features of a new international financial architecture. My colleague from Canada will spend a lot on that. I will be very brief. But for me, the conclusion from that is why we needed that, especially developing countries. Well, we need that because we are not only that do things on the wrong way. Also, developed countries screw up, and we need some way to sort of control them. Maybe the new international financial architecture will help us. And finally, given all these inputs, I'll go directly to the question about if there is a role for regional integration agreements in the formulation and establishment of a new international financial architecture. My answer, being a little bit provocative, is no, but Jose Maria will try to convince me otherwise. Okay, so very briefly about macro management before the recent crisis. As Jose Maria was already saying, governments were not able to act countercyclically. On the contrary, I remember Argentina in 2000 raising taxes in the middle of of the recession, or maybe Peru, Brazil, cutting investment in infrastructure, which is very important for long-term growth. So, in fact, many of the or raising interest rates, etc. So, many of the policies that our countries took at that time, in that period, even, make things even worse. But not only the governments behave in a very pro-cyclical way. Of course, the international financial markets also fueled in part the crisis, giving a lot, sending money and give it to you in any way when things are good, but when things are bad, they want all these guys want you to repay everything in just 6 months. Why? This is because of a very ill analysis of the macro situation of these countries, or whether it is because of incentive problems. And in case we know that credit markets behave in a very pro-cyclical way. But not only the private sector markets, also some of the institutions of the international financial architecture, like IMF, also sort of behave a little bit pro-cyclically, sometimes with, giving you money in a period of bad times, asking you to, cut the fiscal expenditure or cut the deficit, etc. So many of the conditionality that that were attached to these programs were also kind of pro-cyclical. Well, even regional development banks, which are at that point, it was not clear that they have a mandate to help countries on short-run type of crisis. So, okay, so this was how the world was before the crisis. But of course, after these recent years, these 2 years, there were good news, or at least a change in how many of our countries behave. On one hand, let me show you some very few numbers. This crisis was hard. I mean, the idea that export dropped like 40%, price of commodities dropped also 35%. So the crisis in terms of export of real shocks was very, very important. But also on the financial sector, also there was a kind of sudden stop on capital inflows. You see how the interest rate increased a lot, go from 200 basic points to almost 900. And of course, during this period, all the governments could not go to the market to roll over their debt. So we have a strong both trade and financial shocks. Now, of course, as Jose Maria was already saying, the key difference was with respect to previous period was that during 2003 and 2007, many of our countries accumulate a lot of reserves, have a more sustainable fiscal policy, etc., which allow them, of course, when the crisis came, to, for example, intervene. So the reserve accumulation during 2003, 2008 allowed timely intervention during the crisis, and here you see, the bars are exchange rate sales or buys or purchases, and you see not only through quantity adjustment, but also the fact that many of the countries have a more flexible exchange rate. The depreciation of the currencies also help it in the adjustment. But not only that, also monetary and fiscal policy were sort of counter-cyclical. And you see here the policy interest rate for many of the countries. The U.S. started to reduce the interest rate well into 2007. And Latin American countries followed a year later. But you also see, important declines in the the policy interest rate. And of course, on the fiscal side, also there were important stimulus packages. And Argentina, for example, its size was like 7 points of GDP. Brazil almost 10 points of GDP. Chile 4 points of GDP, etc. Mainly, most of the programs was through increase in expenditure, not only, and a little bit less on decrease on taxes. But of course, part of the reason why we are now sort of taken out from the recession is that even though the term of trade declined during the crisis, still on average, we are almost 30% above the average we have between 1990 and 2001. So from the external point of view, from the trade sector, there are also good news which are helping the countries to go to recuperate. Now, so given this sort of very brief macro context of the crisis and the lessons, the question now is why we need a new international financial architecture. So on one hand, we know that this time we didn't screw up. It was mainly a problem of developed countries, okay, that have very important imbalances. So somehow we need, and Jose Maria was saying that, we need some macro policy coordination at the global level, okay? And we hope that through this new institution, make some of these countries, US, maybe China, etc., accommodate policies so that to avoid new crises in the future. But not only that, we need to improve the financial supervision and regulation, especially for assessing systemic risk. When all these guys in 2007 and 8 make risk assessment, of course, at the micro level, many of these loans were okay because the prices of the assets were somehow accommodated or in line with what the loans. But of course, the question is that behind those prices were not sustainable. But this is easy to say, but not easy to ex ante to evaluate, and especially if you do with the private sector to do it. Okay, so how we sort of assess systemic risks so that we have better regulation. That's why we need also a new international financial architecture, and of course to avoid the procyclicality of financial markets. But also, a third reason why we need a new financial architecture is that the recent crisis also show that the propagation of a financial shock could be reduced if timely credit, for liquidity purposes is available, without any conditionality and ready to use. And of course, the leading example is these swaps that U.S. proposed to Brazil, Mexico, and Korea. That was very important to stabilize expectation about how the crisis or the financial crisis will develop in some of these countries. So these are three reasons. There are maybe many more. Why is that we need a new financial architecture? But the idea is that all these policies cannot, of course, be introduced in a unilateral way. There are strong gains of policy coordination to avoid negative externalities. As Jose Maria was saying, the lesson from the crisis was that those countries that saved during the good times were in better shape to sort of face the crisis. But from there, it could be a wrong conclusion that you had to maximize savings, and because that could deteriorate the aggregate world demand, etc. So somehow we need to make individual country saving decisions more efficiently from a global point of view. Okay? And of course, many of these policies had to be also enforced on developed countries, okay? On developed countries. So as it stands, the actual financial institutions, say IMF, maybe is not prepared to do this kind of job. So we need, on one hand, a more balanced governance where developed countries feel also the pressure to reform, okay? Of course, the G20 decisions and commitments that we already know, already were released, are a first good step towards this. But it's not clear how the new IFA structure will develop out of that. And maybe my colleague from Canada will say something about that. But now, within this sort of context, the question is, could regional integration agreement help in building this new institution, financial institutions? My answer will be, I don't think so. But we'll see. I want to be provocative, okay? So, why is that so? Why is that I think that the regional integration agreements had little to do on this? Well, first, whatever the initial purpose of the regional integration agreement we know in the region, say Mercosur, Mercosur, CAN, NAFTA, are in practice mostly trade agreements, okay? And many of these agreements, and Mercosur especially, have advanced very little beyond the trade issues. Okay? So there were attempts at include some formal mechanisms of macro policy coordination, but still we see that they are not successful. Even during the crisis, you tell me, I mean, I need to be convinced on that, on your point, okay? I didn't see any special role that Mercosur, NAFTA played in proposing things to coordinate macro policy to avoid these things. It's not at all, I mean. You mentioned that Argentina and Brazil are in the G20, which are two countries from Mercosur. But it was just that we were there, it's just for luck. I mean, it's not the case that Brazil...
It was a mistake.
No, I would say, you know, we did some good thing in the past, so that's why they're paying us for us. So it's not that Brazil opinion at the G20 is different because it belongs to a regional integration agreement, so there are some lessons that from there, no, at all. Even Argentina, even I don't know even if they coordinate themselves. I think so, but so even more than that, regional integration agreement did not help during the crisis to do the first thing they had to do, which is to maintain more or less markets open. At least, you know, there were a lot of noise in Mercosur, but also in CAN, in the Andean community. I mean, Ecuador rose the tariffs just unilaterally in the middle of the crisis against their neighborhoods. So in summary, I would say that I don't see from what actually happened anything that the RIAs could add in terms of assuring a better institutionality or whatever on the financial sector. 5 minutes, okay, that's good. But beyond the problem of lack of commitment of regional integration agreements to macro issues, I think there are maybe conceptual reasons why is that the regional integration agreement has nothing to do with the new international financial institution. On one sense, the sort of public good that we need to provide by the new international financial architecture goes well beyond the regional sphere, in the sense that the shocks that need to be smooth are many times cross-regional. So you don't think that some common fund between Argentina and Brazil will help us to smooth the shocks that we think is going to be the same for the two countries because we have the same economic structure, etc. To me, it's good to separate things. We need RIAs, we need regional integration agreements to enforce trade openness at the regional and global level, of course, together with the WTO, okay? On the other hand, we need a new international financial infrastructure to enforce macro coordination policies at the global level, to set short-term credit lines for liquidity purposes, and to propose and enforce new standards in financial supervision. And there are big risks if this is not done in a good way. For example, that all the lending for development could be cut because of fears of financial crisis or financial contagion, etc. Now, there is one dimension in which the regional thing could help to build a new financial infrastructure that try to address these three things. This is by strengthening regional development banks, regional level of. So the idea is that we have some regional development banks. We have IDB, we have CAF, we have I don't know, Banco del Sur. We'll see. And to strengthen those banks and maybe give them also a role in terms of macro, offer some kind of short-term liquidity loans, and also to sort of help to intermediate funds from surplus countries to deficit countries, that will be interesting. But these banks need to be funded not only by funds from the countries from the region, need to go to the world market. Somehow it's another way to put the excess of savings from China, not only go to US, go to Latin America, in which they have some good opportunity for investment. But you see, all these regional banks have very sort of loose link to regional integration agreements. Let's talk about CAF, which I'm from CAF. CAF now is a South American development bank. 40 years ago, it was originated by the the Andean community, but it's no longer related formally and informally to the Andean community at all. So that's why I'm saying maybe we have some regional dimension to improve the financial architecture, but it's not in the institution that today we have that governs the regional integration agreement. I mean, Mercosur, CAN, etc. And maybe there are good reasons to mix the two things, because the political economy pressure on trade issue is sort of special. I don't want that to mix that with the financial things, in which you don't want the lobby of the industry in Argentina to say something about if we're going to give a credit to Brazil in having a crisis. No, you don't want to mix those things. Maybe. So maybe there's a good reason to have separate institutions. Okay, so with this kind of pessimistic opinion, but I'll leave the way to you guys to convince me otherwise. Okay, thank you.
Thank you, Pablo. So in the morning, we saw that regional integration was not advancing in trade, and so it's useless also for financial issues. So perhaps this meeting signs the demise of regional integration in Latin America. Well, Eric Santor, please.
Okay, it's very much a pleasure to be here today and be invited to the Woodrow Wilson Center. It's a different environment for me, so I've learned a lot this morning. And one thing that came out one thing that was very interesting this morning was there's the description that there's Brazil and its relationship to China, and there's not really local integration. But I can see that there's one place where actually there's heavy integration between Brazil and China, and that's actually Canada at the G20 table, because the seating is alphabetical. So Brazil sits to our right and China sits to our left. So there's actually a place where we can get into the middle of that. So that's maybe there's hope there. Anyways, today I'm going to be presenting on the international monetary system, the global financial architecture, and integration in the Americas. This is some of this work I've been doing with Graydon Paulin from the Financial Stability Department of the bank. I'm from the International Department. Before I begin, I should make it very clear the views presented here are those of the presenter and not those of the Bank of Canada nor its staff. I'll just repeat that, not those of the Bank of Canada nor its staff, so they're not for attribution. The objective, well, we all agree that a well-functioning international monetary system, and I'll describe what that is in a minute, and a global financial architecture underpins macroeconomic growth and financial stability. The crisis clearly highlights the need to reconsider how they should continue to evolve. How should we reform them? Where do we want them to go? What do we want them to do? So the objective today, I'm going to say, in the light of the recent experience, we need to investigate how the international monetary system has evolved over time, and that many of the difficulties that we've had, actually, there's nice lessons from the past we can look back to help us inform us how we have to reform it in the future. I'm going to talk about the institutional structure, that is the global financial architecture that has supported it through time and how it has evolved and how we see it continuing to evolve over time. And then I'm going to think about, and this is where I'm not an expert, but I'm going to ask some questions about, well, Latin American regional integration and what role does it play in the evolving international monetary system and the global financial architecture. Motivation is, very clear. The existing IMS and GFA failed to mitigate the policy failures that led up to the crisis. These included, there are many, many different causes of the crisis. We have these big arguments about whether it was global imbalances or whether it was financial regulatory failures. But let's just agree that there's a little bit of everything contributed to it. But certainly on the international side, forget about the domestic regulatory failures. Now, on the international side, it's very clear the international monetary system did not allow for timely real exchange rate adjustment amongst the major systemically important countries. That is, global imbalances persisted for a very long time and actually helped cause and facilitate the crisis. At the same time, there's this very fragmented and inadequate regulatory regime globally. as the Basel II capital standards didn't deliver what we thought they'd deliver. There's too much pro-cyclicality, and so a lot of the reform measures on macroprudential try to address these things. And lastly, the surveillance over the system by the IMF and other entities like the FSF, before the FSB, lacked sufficient clarity and force with respect to these emerging problems, that they weren't actually, while they identified some of them, they weren't able to actually influence policymakers to make the necessary changes that would have mitigated some of these things that was causing it. So first, I'm going to talk about the international monetary system. Right now, think of the international monetary system as a set of exchange rate arrangements amongst a bunch of countries, two, a set of cross-border financial claims and capital flows. That is all the different things you can imagine where agents trade claims across borders, whether it be banking, debt markets, equity markets, and so on. And then third, a set of institutions that support the activity of the first and the second, that make up these things like the IMF, the FSB, and others. Right now, we sort of have a hybrid system. That is a system of there's some countries that have flexible exchange rates, some have intermediate exchange rates, some have fixed exchange rates. The important thing here is remember this is not a static system. There's been significant evolution in the exchange rate, and exchange rate flexibility and capital mobility has occurred over time. Nevertheless, it's very clear that the current system does not adequately facilitate external adjustment. But let's put this in a historical context. This is 130 years of international monetary system history all on one page. I'm going to do it in 2 minutes, so it's going to be rather broad generalizations, but I think you can take away the main point. There's been previous regimes, starting with the gold standard in 1870, and then the gold exchange standard in the interwar period. At a time when you had a gold standard where central banks were committed to this, adhering to the gold standard. After that fell apart, we moved to the Bretton Woods system, which had fixed yet adjustable exchange rate systems, but with capital immobility. This has since transformed after the collapse of Bretton Woods into a hybrid system, the current one we have now. And each stage along the way, there's been institutions that have sought to support the functioning of the system, either directly or indirectly. So in the interwar period, the BIS was created not necessarily specifically to support the gold standard per se. It was created to facilitate war reparation payments in the interwar period. Nevertheless, many central bankers saw it as a place of international monetary cooperation. In fact, it participated in tried to bail out Credit Anstalt in Austria during a big crisis, and Montagu Norman and others thought this would be a place where central bankers could agree on how to implement the rules of the game over how the gold standard was supposed to work. Likewise, the Bretton Woods was based around the idea that the IMF would play a central role in providing surveillance over the system, providing financing for countries to undertake adjustment. Likewise, the World Bank was going to help the structural side with promoting a lot of growth. Then when we move to the hybrid system, you have another set of institutions layered on top of the existing ones, the G7, the G20, and then also the FSF, and now turned into the FSB. I'll come back to what I mean by market-based flex IT in a moment. So you have an evolution of the international monetary system. You have institutions being built along the way to try to support it. However, there's been some recurring themes in all the different forms of the international monetary system. Generally, there's this tension between this desire for stability, either nominal or real stability, against the need for adjustment to major shocks. So you have a major shock in the interwar period, which is the ascension of the U.S. economy relative to the global economy, or the no shock, which is the integration of a third of humanity in the form of China and India into the global system. At the same time, while you want stability, you have to adjust to these shocks. So every IMS has tried to find this balance on seemingly conflicting needs. That is, you have to adjust, but you want the stability. The difficulty is there's an asymmetry in the adjustment process. Surveillance and deficit countries both need to adjust, but there's a big asymmetry. Both can thwart adjustment. This is very important. Often, but the difficulty, the asymmetry is that deficit countries have a much harder time doing it. A surplus country can, once with foreign inflows, can sterilize them. While there's cost of sterilization, they can be put off a little bit longer, perhaps, than, say, a deficit country, which has to adjust either by running down reserves, devaluing often in a crisis context, or, say, England in the interwar period, trying heroically to put down prices and wages to get back to the pre-war parities. And so, but the adjustment on the deficit countries tends to be a lot harder and a lot more immediate than the surplus countries. However, and as in Bretton Woods, you have the same situation with the U.S. running a big balance of payments deficit and Germany thwarting adjustment all through the 60s, accumulating lots of reserves, not letting it go into the price level, even though they did do revaluations from time to time. The bottom line is that countries often delay this process, that they're in sort of denial of the process. Then it becomes too late, the pressures build, and then the system has a big crisis, and it gets blown off the system, like the gold standard during the 1930s and the Bretton Woods system in the early 70s. One interesting sort of sidebar to this is if you think about where would we like to go in the future, think about an alternative, which is a system not based on the hybrid current flex to flexible, but rather a system where all systemically important countries have floating exchange rates, maxed with some nominal acre, either it be inflation targeting or something else. Some of these symmetry problems start to go away in the immediacy because with exchange rate flexibility, if you're floating, some of these issues go away because it's more immediate. So the question then is, how should this international monetary system evolve? One could argue, and this is actually coming out of the G20, is that systemically important countries should adopt policies that promote external stability underpinned by an IMS that ensures orderly and symmetric adjustment. That's where we'd like to go. That's a reasonable thing to sort of aim for. That's the target. The question is, what form do we want to have that? Can we have a form where we have some intermediate and fixed regimes, also with floating regimes, that facilitate adjustment? Well, for that to happen, you have to have other things in place. And I'll start to talk about, and the question is, are the institutions that manage that process up to the task of doing that? So if you have the current system, and in the current system, if you have some countries that are fixing and some are flexing, they have to take different policy choices in the face of these shocks. How can the system and the institutions that manage the system try to facilitate the proper policy choices? So the global financial architecture, moving to the second part of the presentation, significant evolution has occurred in the institutional structure supporting the IMS, as I mentioned before, and often reform is spurred by crises. They tend not to waste a crisis. All institutions face challenges, various related to their membership. There's lots of membership, their mandate, their instruments, and governance. But it's important to evaluate the system as a whole, not just institution by institution. So we came up with this little chart trying to describe the global financial architecture, and we thought this is there's lots of other institutions out there. These are sort of the big ones we were thinking about. We divided it into principles and agents. We thought about the agents being known as the IMF, the FSB, and the CGF, and then the elements of the BIS. And they're managed by, respectively, the IMFC, the G20, and the BIS. And so what we'd like, and there's different lines of accountability here. So, and this is actually one of the big issues, is how should these lines of accountability be drawn? Right now, it looks like the FSB is more or less accountable to the G20. But the question is does this need to be formalized more broadly? The G20 clearly has overlap with the IMFC. A lot of members of the G20 are also IMFC chairs. The IMFC, is not a formal body, having some accountability over the IMF really is accountable through the Board of Governors and the Executive Board. But the IMFC is now playing a bigger role. And there's a proposal out there to make the IMFC a council of ministers, where it's actually the ministers that are going to be in charge. It will turn into a council and have much more formal political engagement. And there's also growing lines of interaction between the two, whereas you have the IMF and the FSB engaging in an early warning exercise. That is to sort of identify vulnerabilities to the system. And then within the FSB, you have all these different level subcommittees. And then you have this other entity off. The BIS is still out there doing its thing through different committees like the CGFS, the CPSS, that's the payments, the markets committee, and also its relationship to the BCBS, the Basel Committee for Banking Supervision, and then the IOSCO-IS. These are the insurers, the International Accounting Standards Board, and I forget what the IAIS is. I lost in acronyms. Let's think about, when we think about the global financial architecture, we'd like to evaluate whether this GFA that we've constructed to this point and where it's going to go has the following desirable properties. One, does it have the ability to identify risks and vulnerability? So going back up here, does the IMF have the right surveillance tools? Does the FSB have the right set of, is the ordinary warning exercise going to do it? Two, does it actually, having identified some vulnerabilities, does it have the means and instruments to mitigate these risks? So again, going to the IMF, are the lending facilities appropriate to the role that we like it to do? Is the FSB, as a standard setter, going to have enough persuasive power to affect effective policy change within domestic regulatory frameworks? That's an open question. Third, we want to have a clear allocation of responsibilities and clear accountability. The IO report and the manual report very clearly show that the IMF suffers from a big accountability problem. Likewise, the FSB's relationship with the G20 is not clear, and then who's accountable and who is the BIS accountable? Well, it's accountable to central bank governors. But a lot of central bank governors are independent. So is that an appropriate accountability structure? These are open questions. D, how are we going to ensure effective coordination? And E, and this is important, how does it have the ability to evolve to reflect the current environment, the future environment, and promote evolution of the IMS? It's not enough just to mitigate risks to the system. What we found out is that the system got behind. Financial innovation far outpaced current regulatory framework, current ability of the system to manage the risks. How can we ensure the institutions continue to be relevant, have the tools and means necessary to do so? Those are open questions. This brings me to the third part. There's a set of open questions left that the G20 is dealing with, another four as well. Latin America, the IMS, the GFA. How does Latin America fit into these two entities? I'm going to skip the section on financial integration because we've already seen a lot of different aspects of that already. But in terms of exchange rate regimes, this is from the IMF webpage, so if you disagree with the exchange rate categorization, disagree with them, I'm simply making a point here, which is there's a spectrum of different exchange rate arrangements around within Latin America. Importantly, though, interestingly, though, Brazil, Chile, and Mexico, which used to have fixed rates in the past or managed rates, have moved to a floating rate regime. They're still managed to some extent in different dimensions. However, they have moved to that over the future, which is sort of a long-term trend, and one could think that maybe other EMEs will continue to do so. But there's also another mix of crawling pegs and bands, fixed exchange rate regimes, or the US dollar. Different countries have different needs, or different regimes are appropriate to different needs at different times. But there seems to be a long-term trend towards, as you become systemically more important, more developed, you may move into a floating exchange rate. It might be the appropriate regime for you. I'm not going to skip the financial integration bit. Where does Latin America fit into the global financial architecture? Well, there's lots of different specific places it fits in. Within the IMF has universal membership, but that doesn't get you very far because there's 185 countries and your voices can get drowned out with everyone else. However, there is a more direct way in through the IMFC. That is, the IMFC is made up, and the executive board of the IMF has chairs, and so Mexico shares a chair with Spain and Venezuela. They believe they rotate. Brazil, Argentina, and others. And so this is a place where Latin America can feed in directly to the policy discussion through the IMFC. If the IMFC becomes a minister of councils under the proposals of the Monroe report and the IRO report, then this might have sort of a heightened place for interaction with the GFA. Latin America is also involved directly in the FSB as members to Argentina, Brazil, and Mexico. And likewise, within the G20, Argentina, Brazil, and Mexico is also involved. What's very important to remember here is that it appears that the G20 really has assumed the leadership of managing the global financial architecture. If previously the G7 thought that it may have, G7 seems to be taking a second place relative to the G20. G20 really is where the action is right now. And it'll be interesting to see how this develops over time. And so Latin America has 3 voices on the G20 and is in the room. And lastly, within the BIS, Argentina, Brazil, Chile, and Mexico are one of the 57 central bank members of the BIS, and they interact there as well. So there's lots of places where Latin America, as individual countries, can include themselves in the global financial architecture and help shape the debate about where we're going. So the question is it sufficient for Latin America to be integrated through the IMF, the FSB, the G20, and the BIS? Is there a role for regional arrangements? Not really sure there's an answer to that. There are numerous regional arrangements. I have a research assistant pull all the different regional arrangements that exist within Latin America, and they're mostly trade-related. There's some others, and there's a very long list. But can these particular regional arrangements form the basis for further regional integration? The question that I would ask is, should these arrangements be viewed as substitutes or as complements? The question is, so if you think that you're going to feed into, if Latin American countries are going to feed in through the existing structure, is there a role that they're going to play? But could that take away from their being more vested in that system as opposed to something else? Or and if it's a substitute, is it the right substitute? And so are different proposals like having a Latin American Shanghai initiative, is that going to solve the problem? Because if the problem is a global one of surplus and deficit countries facilitating adjustment, does that particular arrangement facilitate that particular thing? And it's not really clear. It's perhaps a different issue about diversification, risk pooling, not necessarily facilitating adjustment, which is the underlying problem that we have. So the question is, are the current set of reforms being proposed adequate? And I would point out the question, do regional initiatives ultimately promote adjustment? That's the tension that we have. That's the history of the international monetary system from the gold standard to today, is that sovereign countries can, if they want to, thwart the adjustment process. The question is, how do you get countries to undertake their share or their burden of the adjustment process in a group? I'll just mention some things in IMF reform because this is often thought as one of the ways that you can go about doing this. The question here is there's some really big hurdles to IMF reform, and because I'll get to what it means later. So on the governance side, the G20 has committed to a quota reform of allocating 5% of quota from advanced countries to developing countries for those who are overrepresented to those who are underrepresented. That means different things to different people. At the same time, and that has to be done by 2011. That's going to be a very difficult reform to do. The previous is bigger than the previous reform. That one was easier. On the corporate governance side, as I mentioned before, the Monroe report and the IRO report highlighted in our own work, has highlighted many deficiencies within the corporate governance structure, decision-making process of the IMF. Roles and responsibilities are not clearly defined. The executive board is too involved in the day-to-day management of the fund. The MD selection process is biased. There's no accountability for the executive board, or supposedly for the MD and elsewhere. Given that governance environment, some people have argued, well, perhaps we can augment the resources of the fund, use the FCL and augment it again, provide an alternative to reserve accumulation. Providing an alternative reserve accumulation depends on the credibility of the IMF delivering those funds when they're actually needed, and do they have enough funds to do so? The question is the membership willing to give the IMF that amount of resources and that amount of discretion, or not discretion, or a set of rules that would govern the allocation of those types of arrangements? So that's a very good question. Are we going to have the IMF as provide insurance facilities, there's a proposal out there, or swap arrangements or other proposals? Well, that's going to, in order to deliver that, to make it more like a central bank, you're going to have more governance, you're going to have this governance structure more like a central bank. That implies more independence. Are the membership willing to create that distance between the IMF and its membership in those ways, as central banks have domestically? Lastly, in terms of surveillance, we did have the 2007 surveillance decision reform that was seen as progress, but there tended to be an overemphasis on calculating equilibrium exchange rates. So there's a lot of pushback on that. What we're really after are the idea that the IMF will provide candid, even-handed, and objective surveillance. And in order for it to be able to do that, we need to have a governance structure that will provide protection to staff and management to deliver on that. What's interesting here is going back to the idea of adjustment, surpluses for deficit countries, and how we're going to resolve the accumulation of reserves and other things. There is a role the IMF is going to play in the bigger picture, which is the G20 framework for strong, sustained, and balanced growth. This is probably this is a lot's been put on this one, which is to say the G20 is going to come together, use the IMF. What countries are going to give the IMF their sort of policy frameworks. The IMF is going to collect it all together, do a projection, and they're going to engage in a mutual assessment program, and the Latin American country is going to be part of that process. And then from there, they're going to make policy recommendations both globally, and then they're going to refine them. That's the language in the communique. They're going to refine them in the future to be perhaps more country-specific. We'll have to see what happens. But that said, this is a collective exercise to try and get countries to undertake policies that will facilitate adjustment both for surplus and deficit countries. So that's probably where the big hope is right now, and avoiding some of the problems we're going to have in the future. The question is, how does Latin America fit into this? Well, they're going to fit in through direct membership of these institutions, but it's not clear how regional arrangements facilitate this sort of agenda that's going on in the global financial architecture. So in conclusion, the IMS continues to evolve, but faces the same tensions as always faced since 1870 and onwards. The global financial architecture is evolving along with the IMS, but clearly reform is needed to improve both the, think about mandates, membership, functioning, accountability, and other things. In terms of Latin American regional integration, what role to be played in the evolving IMS GFA? Well, that's something for Latin American countries to decide. They have to think about how they want to play use their membership at the table, at the G20, the FSB, the IMFC, or the Ministerial Councils, and other fora, and how they're going to contribute to the policy discussion that's going on right now, that we need to solve this big problem which has yet to be solved. Global imbalances are still persisting. Thank you very much.
Thank you, Eric. Well, now the floor is open for questions, comments, replies. Jose has a challenge. He needs to to prove that regional integration can help. Yes, here. Two hands. Okay.
Okay, well, I've got two questions which are not particularly related to each other. The first one has to do with how we can help to explain why Latin America didn't have a financial crisis this time around. And both Jose Maria and Pablo talked about the idea of self-insurance. I think there's a bit of an identification problem here. I think that for the Asian countries that were involved in the Asian financial crisis, there was indeed a decision to accumulate reserves to help deal with future potential problems. It seems to me that in the Chinese case and in the Latin American cases, in the opposite way, that it was simply trade flows that led to reserves, not a decision to self-insure. But I'm interested in being informed about this. And then the second issue has to do with the basic topic of the panel. Can regional mechanisms help to deal with some of these international financial architecture problems? Now, we already know there's a big disagreement, supposedly, I'm not sure there really is, but supposedly between the first two speakers. But let me address my question in a way to a point that Eric made. He said, can these institutions, these regional institutions, really promote adjustments, which he says is the real problem of the international financial and monetary systems? But I think this may be asking too much of them. Isn't at least an important part of the question, can regional mechanisms help deal with the impact of these international maladjustments at the regional and individual country level? So it seems to me we're setting the bar a bit too high in terms of what regional mechanisms possibly could do to help deal with some of these problems.
Thank you. Thanks. Cindy Arnson again. A number of you pointed to a set of desired changes in the international financial architecture, and I think Pablo was the only one who expressed a degree of pessimism about whether or not those changes would take place. And I'd like to ask the panelists, where do you see the impetus for change coming from? And is there a sufficiently strong coalition of countries, of institutions with power in the international financial system to implement the kinds of changes that would be certainly of benefit to Latin American countries?
Yeah.
If Eric allows me, I would like to pick a small piece of your presentation in order to enlarge it. The European Union and the International Monetary Fund. How does the European Union participate in the International Monetary Fund? I will explain it to you. There are the constituencies, there are uninominal constituencies, and constituencies that put together a series of countries. In the International Monetary Fund, Spain is a Latin American country. It is in a constituency, as Eric has said, with Mexico, Venezuela, and the Central American countries, which means that Spain in the IMF is represented sometimes by an honest civil servant of President Chavez. Some countries are in uninominal constituencies. Belgium and the Netherlands have been always very important in the IMF because they have been the leaders always of constituencies, the one with the Balkan countries and the other with Kazakhstan and countries like this. Italy goes together with Portugal and Timor, among others, and the Nordic countries, of course, go together and sometimes are represented by Iceland. And Ireland, it's clear, Ireland is an island and speaks English, so it goes together with Jamaica, Antigua, Barbuda, St. Vincent, the Grenadines, and so on. But as they are all very small and they do not have the necessary weight, they need a big boss to represent all of them, which is Canada. I was told for the first time of this here in Washington by Randy Henning in '96. With all the common sense of Randy, he was convinced that after the entry in the third phase of the monetary union, this would be changed. To change this, you don't need to modify quotas and voting. You need simply to reallocate chairs. And the reallocation of chairs would be applauded by everyone in the IMF because it will necessarily conduct to a reduction in the number of European members of the executive board that would liberate places for members from other countries that would be very happy to have the privileges of sitting in the executive board. I mention this because on the one side, this is coming to earth with all this discussion about regional integration agreements and the international financial architecture. But it proves also to Pablo that instead of setting the bar very high, we come to Earth with small problems, such as the organization in the IMF, something that is completely taboo in Brussels. Taboo, completely. Because no Director General of the Treasury will accept never to discuss this, because he knows, or she knows, that if he's fired sometimes, he can go to Washington and have a very good post there. So if this is taboo, and then we go to some regional accepted, multilateralized mechanism of swaps among central banks, here there is something to do. And here asymmetries, as you say in Latin America, I hate the word, differences of size and of power may even help. Brazil, it's completely impossible to control the exchange rate of the real. But the Central Bank of Brazil can help with swaps to that of Uruguay and Paraguay. If we began to think in this kind of mechanism, I think that there is a very modest but maybe useful way of finding a place for regional agreements in the international financial architecture. And of course, for the European Union, rearranging the constituencies. You'll understand that until the European Union does not arrange the constituencies, all the talking about the political union will enter my right ear and will left immediately by my left ear.
Roberto?
Just very briefly, because it's very much in the same line as Cindy said. I was pleased by Sandor's presentation because he brought history into the picture. There was one phrase that says that one of the advantages of time is that helps everything from happening at the same time. But then you are faced to the past, and when you are faced to the past, because time goes by, then you tend to see things repeating themselves one after the other. This discussion about international financial architecture has been there for a long time, and the problems have been, as you said, one of adjustment, and there has been another big problem, which is that of liquidity. There have been two big issues, not completely unrelated one to the other. Now, the question is, what are the incentives, what are the new conditions in terms of, let's say, demand and supply that give any indication that there can be any substantial change in how the regime is organized? I think that is the policy relevant question, not whether there are optimal policies, which obviously there are, but which are the feasible policies, considering the institutional and the political and the other kind of constraints. There was an international exchange rate regime that was, I would say, relatively efficient in the last 30 years, which was the pre-1987 European monetary system. It was pre-1987. It was very effective. So, I mean, what needs to be done, it's not completely unknown. We don't need to invent anything new. The problem is that which were the incentives to have that system working for that period of time. And here I think that although regional arrangements to stabilize exchange rates may play a role, the question is what is going to be the anchor in Latin America or in the Southern Cone? Because it's not just a matter of finding the answer, but also finding a way in which that policy response can be built in practical terms.
Any more questions? I have just one small comment. I don't know if it is a question, but I think Eric mentioned that the G20 is now on the center of the stage instead of the G7. So that surely means something, because developing countries now have a voice in international negotiations, at least in international financial negotiations, which previously they didn't have. I don't know to what extent they are taking advantage of this voice or to what extent this voice is united or unified, or is and this has something to do with regional integration. I think that Pablo wondered if Argentina and Brazil coordinated their position in G20, and perhaps we are missing an opportunities as developing countries to use this forum, which is very important and has replaced G7 at the center of the stage. Well, perhaps we can return to the original sequence. Jose?
Okay. In finance sequencing, it's always a problem, but
No.
well, first of all, I don't think we have too many differences. Or, in fact, the point is that I say in my presentation, I wrote possible contributions. I didn't say highly probable or highly optimistic view about this. So, the point is that if there are some kind of optimization exercise that you can do, and then introduce political economy considerations of the kind that Roberto was talking about. So, from my point of view, the exercise that I have made, and I am not very optimistic, but perhaps I am a little optimistic about this. If it has some value, the value is to look at the problem. If it is valuable, the point is that first, the prior international financial architecture wasn't working well, so we have to do something about that. Secondly, it was very difficult to build new rules of the game for anything at the international level. Third, we have had some kind of success in building some rules within Mercosur. And the point is not if the situation now is optimal, but what the counterfactual situation would be. So if we have had this kind of international crisis, a fall in trade of the magnitude we are seeing, and no place where to discuss this, I think the situation would be worse, not better. So the counterfactual is not the optimum. The counterfactual is what would have happened if this kind of rule of the game of proto-institutional infrastructure weren't there. So this for the past, but for the future is not that brilliant anyway. So the point is that we have countries that are running trade surpluses and countries which are running trade deficits. And these are huge, and the pattern is systematic. Those running trade surpluses are supposed to run these trade surpluses for a long time. And we have a problem. We cannot, and it is not the 90s, it is the problem we have now. So, if we don't fix the international financial architecture, we are going to have these defensive situations. It's a kind of reflection on financial side of the trade side. If you want to develop your country on the basis of exports and you don't want to import, you are a mercantilist. Well, if you do this on the uncertainty, macroeconomic uncertainty side, you are kind of financial mercantilist, you are a self-insurance country. So I think it's an important problem, and we have to look for solutions for this. Concerning your questions, because most of the interventions were comments, and I appreciate the comments. So only for 2 or 3 questions. First, in the case of Chile Chile's trade surplus. It was accompanied by a fiscal surplus and the accumulation of foreign reserves in an international fund. So it is clear a political decision.
That was a fiscal issue.
Right, but
As a counterbalance with a trade account, but that was a fiscal decision.
I agree. But the point is that I agree with you. But the point is that when you run a trade, a current surplus, right? This is the adapts to the fiscal and private surpluses. So there was kind of a political decision. Second, in the case of Argentina, we have been running for the first time in our history 7 years in a row of fiscal primary fiscal surpluses and total fiscal surpluses. In the case of Brazil, I don't think you have any prior observations of the accumulation of reserves in the central bank. And in this case, it's very interesting because it cannot be explained by current account surpluses. You must take a look at the capital inflows. And so you can ask why Brazil is receiving capital inflows and at the same time accumulating reserves with a very small current account. So if you look at the policy stance in Latin America, I think you have all the signals that it was a policy decision and that it have paid off, because we, for the first time, we are not, on the spot. Nobody's talking about the financial crisis. I feel uncomfortable, really. So, and my last point has to do with the future again. And the future is completely different from the past. And from my point of view, the question is, can you look at future evolution of trade without taking a look at what is going on the macro side and the financial side? My answer is no. And since my answer is no, it is not possible to think about regional trade integration without financial integration and macroeconomic policy coordination. And this is more so now than in the past because of the crisis. Let me just put an example. If you look at the world, we are expecting the world will continue, but will restore growth next year. And when you look at the world as a whole, and you say, okay, the world is going to grow. Why? Because of stimulus packages. The world is going to grow with a zero interest rate and huge increase in fiscal deficit. When you look at the future, you say, okay, and this will be in the future the sources of increase in aggregate demand. The response is no, because it is impossible. Because if it were the case, then imbalances will be there forever. So there must be a change between those countries that now are exporting more. They have to increase domestic demand. And if they are mercantilists or follow self-insurance policies, this will not be possible. So if we say that we are not going to tackle this kind of policies, we are saying that we expect that we are going to live on stimulus packages forever and ever. We need the demand for goods from the north to increase in the future, because the sources of growth are in emerging countries, and emerging countries must run, I wouldn't say trade deficits, but we are not going to fix imbalances if they are, afraid of having a balanced current account. And for that, we need an international financial architecture. And to build the international financial architecture, I think an intermediate step can be regional agreements. And let me tell you something. You talk a lot about Argentina, Brazil, and Latin America. And I talk about Chiang Mai initiative, that I think it was a response. Yes, they have been advancing in institution building, and I completely agree with the small things about, I don't want grand architectures. I just want to build swap arrangements one day, another day I try to develop a regional bond market, and maybe in the future we are going to have more and more financial relationships between our countries.
Thank you. Pablo?
Okay. So, my pessimistic observation about RIA is you have to take it as a provocative thing, and in terms of making us think how is it this relationship between trade that is supported by WTO, by regional international agreements, and the way to avoid the spread of this financial crisis. Of course, there is a link, and the link, which is very important, which actually Jose Maria emphasized it, is let's keep trade open. That's and Eric was also saying that part of the problem is to facilitate adjustment. Making trade open is a way to facilitate adjustment. You see, one lesson that we have from with the crisis in the 30s that didn't happen in this crisis was that in the 30s countries started to put up barriers to trade as a way to try to stimulate domestic demand, and of course everyone do the same, and the thing was even worse. So, and why is that so? Because, for example, when in the middle of the crisis, we Argentinians have no spare money to spend, but Chile has a lot of money to spend. And I was saying to my friends in Chile, you guys start spending all this money you have saved, because through imports, it's gonna help us, you see? And of course, at some point, there were countries that were saying, okay, we're gonna do a expenditure package, stimulus, but we know that part of the stimulus goes away to other countries through imports. We don't want that. So first we're going to raise tariffs, and then we'll do the stimulus. You see, this is the kind of thing you have to avoid. And of course, now this is understood. And one of the first things the G20 did, it was to avoid this, and Mercosur helped to maintain trade barriers, relatively low, and also other type of trade agreements. So it is a role, and to maintain trade open in this situation helps to adjustment. So I don't want to sort of say that this is not important. But of course, beyond that, beyond trade, there may be some informal things that you mentioned. For example, Argentina and Brazil, in the middle of the thing, Brazil offered some swaps in terms of the local currency to Argentina and vice versa. This is also important, and so I'm not saying that the regional international agreement play no role, but I would say that you can do many things, and maybe the more formal things. Maybe is the way to go is not to introduce within Mercosur a sort of arrangements to tackle these things, when at Mercosur still we have problems with trade. That's the only thing I'm saying. Maybe we need another type of institution, which could be a regional bank like CAF. We could be a FLAR in the case of Andean community, etc. So it's good to add more institutional density, because we have many problems, and many times is to use many instruments for many problems. Okay, so this one thing. There was a question about the desired change in international financial architecture, whether the impetus comes, and whether this time Latin American country has something to say. Well, already Eric mentioned that. I think the new thing about the G20 is that we see some of the developing countries have a strong leadership there. Brazil, even Argentina, and so now you feel it that you add it with the big guys, and the big guys somehow hear you. They want to ask you some questions. So I guess this is very helpful. Whether this will, turn out in a sort of institution that Argentina will have the same vote that U.S. in financial matters, I don't know. But this is already a change that I think is very good. That's it.
Eric?
Just a few comments. So where will the impetus of change come from? Well, I like to be very optimistic about these things. Canada is a small open economy, is much like many Latin American economies, and we have a vested interest having a very stable and efficient market-based international monetary system. So we would like to hope that countries with shared interests see it in their self-interest to promote a stable system. And so one of the arguments one could make, hypothetically, is think about the big players that need to make adjustments. It's in their interest to do it, because if you don't facilitate adjustment, the system's going to run into problems again. And so if you think about, China would imagine that China would like Shanghai to be an international financial center sometime in the not so distant future. In order to do that, it needs to move towards exchange rate convertibility and a more open capital account, and do a bunch of other policy actions that would be consistent with them providing facilitating adjustment. And so we like to think that there are certain things that would be in the interest of countries to undertake these things. Now, the impetus of change is also going to come from the fact that the G20 is engaged in a way that it hasn't been engaged in before, and in particular the U.S. lead in that. And you see this in the G20 framework for strong, sustained, and balanced growth. Now, it could be the case this comes to nothing, but there is an opportunity here for countries to sit around the table and engage with each other about what the policy choices they need to make in order to facilitate this adjustment. So what's in it for Latin America is, well, we'd all like a more stable international monetary system. Canada, much like Latin American countries, did not have a financial crisis, but we suffered, very hard. We suffered a lot because of the cyclical downturn in the U.S. and the fact that our economy, 80% of our GDP is trade, and 80% of our exports go to the U.S., or 75 to 80% of our exports go to the U.S. So we have a big interest in making sure that the system is stable. So I'm hoping the impetus, and then the other side, on the financial stability side, the FSB really is pushing ahead. They're making real progress right now, and so if they can keep the momentum up, they're going to put in better rules, and some sort of macroprudential rule is coming that's going to be implemented, I think. I mean, this is what form it takes is going to be a discussion. It's going to take some heavy bargaining, but there's going to be something, because there's a recognition that the previous regime had too much procyclicality in it. So there's hope there. In terms of what the most feasible policies that you can do today, because I have an idea of where the world could end up, or other people have an idea where the world can end up. What can be done today? So the G20 framework is a concrete process that leaders hopefully would like to sign up to and deliver on. So there is something there. Whether or not policies get implemented we'll have to wait and see. In terms of the FSB, they will be setting standards, hopefully, that people will accrue to or will accede to over time. So that's a tangible thing. And their progress report to the G20, which you can read on G20 website, there is progress has been made. So there's there's policy action being taken there. But however, again, this all depends on countries' willingness to start sharing some of the burden of the relative adjustment that has to happen, and that's sort of a difficult issue. Lastly, back to the point about constituencies and the IMF. As someone who's been working on IMF issues for about 5 or 6 years now, it's amazing the inertia that exists within international institutions. The prerogatives that are protected are fought over fiercely. There is, and this is actually, it came up very clearly in the recent round of the G20, which is the U.S. proposal to shrink the seats from 24 to 20. That caused, that was a huge fight over whether or not that was going to happen. And then when you layer on the fact you want to make the IMFC into a council, which will have more formal representation, well, who's going to be on that council? Is it going to be 24 or 20? And people will cite, Belgium has more, more votes than much larger countries, and why the constituency framework. The one point about the constituencies that's important is it does allow very small countries to have some voice through their constituency member, depending on how well their constituency member behaves. So there's a reason to have it. However, how you align those constituencies is right now it's an outcome of history. which could be rationalized. Now, the other issue on the table is why doesn't the EU or the euro area go to 1 chair or 2 chairs for the whole region, and effectively have the same size of voting power as the U.S. chair? It's interesting that they haven't. That's a possibility as well. I find it a fascinating issue. It's a smaller issue, but it goes to the heart of how international institutions have a lot of inertia in them. So to get change, you really have to push. You have to push for a long time. So it could happen, but we'll see. Anyway, and then last point on the G20. The G20. This is where emerging markets, Latin America, has a chance to have a voice at the table. Our deputy governor gave a speech about 3 years ago when he's talking about quota reform, but also this applies more generally, which is with greater role comes greater responsibility, and so we all have to step up and behave well within the international monetary system, within the global financial architecture, that we take the role seriously and put the resources into doing it. Now, this is a challenge for a lot of countries. They have to build the institutional framework to deliver very high quality interventions, ideas, policy suggestions that are meaningful to have influence at the table. Because at the end of the day, it is 40, 50 people sitting at a table making a decision. The quality of your intervention, the quality of the policy advice you give matters. It's not just about who's the biggest country, who has the biggest GDP in the room. It also matters what policy ideas are on the table. So Latin America has a role here, which is to bring expertise to the table and to do it in a meaningful way. So.
Thank you. We have time for one last question. One final. Jose?
Thank you. I just had a quick comment to make to a point that Eric made a minute ago regarding the country's willingness and their own self-interest. What you've described basically is a traditional problem of cooperation and international relations, which is what these regional agreements were supposed to overcome in the first place, or were supposed to be useful for in the first place, to produce coordinated positions, to get countries to cooperate where they otherwise wouldn't do that. So perhaps what you're saying, in a sense, is that maybe there is a role, it's talking about lowering that bar, that there is really a role for regional trading agreements or regional institutions in Latin America simply as cooperation mechanisms to formulate common positions in an international financial architecture when there is no clear information, or there are informational asymmetries or other types of traditional problems of international cooperation that surface again in this area, which is not trade, but that they can still provide a useful forum.
Well, okay. I have a suggestion of eliminating the coffee break in order to end timely, according to the schedule. So if there's no opposition to that idea, we would continue with the next and final panel. It's okay?
Yes, if people want to go out and grab a cup of coffee and come in,
Yeah, but
keep
just
going.
very brief.